Good morning, everyone. I'm Greg Barron, President of RCEDC, and it's my pleasure to welcome you to our third calendar quarter Leadership Council meeting. Our Leadership Council members will find their meeting materials in their emails. Note that there's excellent information, including the leadership package, along with the mid-year results from our strategic plan, the 2021 Form 990 that was presented to our board of directors earlier this morning, our current financial statements, and minutes from our last meeting. Now, call out to all Leadership Council members. If you have any questions, please let Jenny Trick know and she'll respond back to you. You'll recall that starting last year, we opened our Leadership Council meetings to the public. We did this because it provides us another opportunity to inform the business community about the economic developments across Racine County. At our last meeting, we hosted 2 venture capital groups, and today we welcome Brian Andrew from Johnson Wealth to provide an overview of the economy. Brian will be thoroughly introduced in just a few minutes, but before Brian's presentation, we're going to have our RCEDC managers provide a mid-year report on the strategic plan. So to get us started, I'm going to turn the mic over to Carolyn Engel, RCEDC's Business Finance Manager. Carolyn, over to you.
Thank you, Greg, and good morning, everyone. Laura Millian and I are pleased to highlight a number of projects that have been announced over the last 6 months. Starting from the west, we'll focus on Burlington first. So far this year, RCEDC and Burlington were able to recruit a new business to the city's downtown, support 3 existing businesses with their expansion projects, and host an event at the Loop to recognize a handful of small businesses in Burlington. The 4 companies listed on the screen used 3 different financial programs successfully to complete their projects. The 3 programs were RCEDC's funded RLF, Burlington's Revolving Loan Fund RLF, and the Burlington Grant Program. A total of 46 new jobs will be created by these expanding businesses. Congratulations, Mayor Hefty, on these announcements. So regarding the Beers and Business event that we held at the Loop in Burlington, we were so pleased with the attendance and the energy in the room. The speakers did a good job of telling their story with honesty and humor. Our next business growth event is scheduled for July 21st at the Murray Mansion, where we'll focus on the food and beverage industry. More information about registering for this event is on our website.
In Waterford, we were pleased to celebrate with President Don Houston and his staff to welcome a new construction project, the Waterford Lofts. This project will be a mixed-use project, which includes commercial and service businesses on the first floor with residential condos on the second and third floor. RCEDC provided support in submitting a grant application to WEDC for $250,000 in support of this project. In addition to this project, we supported 2 companies with Racine County matching grants, Flitz International and Waterford Stillhouse. Both were able to use the grant to be able to expand their online marketing presence. Overall, more than $6 million in new investments was announced in Waterford this past 6 months. Congratulations, President Houston. Regarding the Waterford Lofts project, we were pleased to issue a press release in support of Waterford and their development partner, Wisconsin Redevelopment, which resulted in positive coverage. As you can see from the slide, the story was picked up by 6 publications. And for the groundbreaking event itself, we had great website traffic, newsletter engagement, and interaction on social media.
RCEDC was also pleased to partner with President Steve Wickland to support 2 small businesses in Union Grove. The first is a women-owned business called Beauty and Brow. They utilize the newest Racine County grant program, the CDBG-CV program. As you can see, the state government is not clever with its grant names. But regardless, the new grant has been a critical lifeline to many local small businesses. Like this company, many grant recipients are using the dollars to offset the losses of revenues that resulted from COVID. If any of our leaders are aware of small businesses with 5 or less employees that were negatively impacted by COVID, please contact me after today's meeting. The second company, T-Max Saloon, is a favorite food and beverage operation that has a large, loyal fan base in Union Grove. The community's loyalty is certainly understandable when you check out their Facebook page and see the support that they provide to the chamber, local fundraising, the village's 4th of July parade, and more. To continue to grow its customer base, the company made significant investments to its property. The Union Grove grant was able to provide $10,000 to support this company's expansion project. A special thanks to President Wickland for supporting local businesses with its creative, locally sourced loan funds. One of the grant recipients, Beauty and Brow, was featured in a press release. The story was picked up by the Journal-Times, and the call to action was followed. We had several calls and emails from businesses wanting to apply for this grant. This is just another great example with our marketing team to get the word out about the different programs. In Yorkville, Jordan Brown, RCEDC's business recruitment staff, worked with a national site selector to help Amazon to expand its services in the area. This time, the company needed site selection assistance to support its electric vehicle initiative. According to the plan submitted to Yorkville, as many as 760 electric vehicles will be charged at its new Yorkville location. Amazon's spokesperson has said that they are working to electrify 100,000 delivery vans by 2030. They are working to establish electric charging stations across the country. Our lending staff was also able to support growing companies in Yorkville. The first, Northern Mechanical, owner Scott Vogue had outgrown working from his own property, so he decided to purchase a vacant building in Yorkville. RCEDC was pleased to partner with Town Bank. We were able to provide Racine County match grant dollars to support its growth, an SBA loan on this one as well to support its growth. And finally, in Yorkville, Racine County provided Speedy Packaging with both a matching grant and a 0 RLF loan to support its needs. Congratulations, President Nelson, for securing the Amazon project and for supporting the growth of existing businesses.
In Sturtevant, our staff has been working with President Rosenbaum to develop 2 new programs to support Sturtevant's businesses. You may have seen the press release announcing the village board approved a new RLF program and a new grant program, which we'll cover in the next slide. Another local business our team was able to support was M&J Kruger, an ethnic minority women-owned trucking company, which continues to grow. The company was able to tap into the 0 RLF program for the company's purchase of additional trucking equipment. Finally, our staff was able to successfully secure a buyer for one of the village-owned parcels. This sale to A+ Auto will allow the company to build a new facility and add more workforce. It's worth noting that the village has 3 more parcels to sell and develop. If our leaders know of potential buyers, please contact me after today's meeting. Congratulations, President Rosenbaum, for announcing nearly $1 million of new private investment in our community. As I mentioned in the previous slide, Sturtevant set up a new loan and grant program in the last 6 months. It didn't take us long before we had our first applicant, Nona's Pizzeria, who secured a lease in the old Driftwood Lounge building and applied for funding through the grant program. To broadcast this new program, we issued a press release announcing the funds and featuring Nona's Pizzeria. Here again, the Journal-Times picked up the story and more interest in the program followed. The village of Mount Pleasant was successful in securing an exciting manufacturing company, Oterra, to its village. A total of $40 million in new investment and 115 new full-time employees will be hired by the company in the coming days. This project was one that included the Milwaukee 7 and the Wisconsin Economic Development Corporation. We were thankful for the partnership as well as a positive outcome. Additionally, there were 2 companies in Mount Pleasant that we were able to support with the new Racine County CDBG CV grant, and 3 companies received Racine County matching grants. Finally, the sixth company that we were able to work with was Advanced Care Specialist, who utilized the Zero RLF through RCEDC to purchase equipment. Congratulations, President DeGroot, for securing Oterra and for supporting 5 existing companies who will invest $40+ million in your community and create 134 new jobs. Over the last 6 months, I spent a lot of time in Caledonia. All of that time and effort has resulted in 2 large announcements. The DeBack Farms Business Park is nearly out of land after selling 65 acres to Scannell Properties in 2021. The most recent development project is from Likewise Partners, which submitted plans to develop a nearly 200,000 square foot spec building in the park. Appreciating the opportunities available in the Highway K area in Caledonia, the Zilber property team is finalizing its plans to buy land south of Highway K and develop a 100-acre business park. This park is planned to be home to 1.6 million square feet of space. Our team is also pleased to be able to support local businesses, Stevens Auto Service with a CDBG CD grant to offset some of the revenue losses the company experienced as a result of COVID. President Dobbs, I'm sure you are pleased with the numbers: 100 new business park acres, more than 100 million in investments announced, and resources to support small businesses. Congratulations. I'm pleased to share this slide. This project started prior to the pandemic, and we were excited recently to celebrate with CSL USA, an Italian-owned probiotics manufacturer, with the grand opening of their 80,000 square foot facility. We had a chance to gather with the company, state and county elected leaders, Caledonia leadership to celebrate the start of their manufacturing operations. It's rewarding to see a project from its inception to its fruition. So congratulations to CSL and to Caledonia. A total of 13 businesses from the city of Racine received financial support from RCEDC these past 6 months. Many of you may have seen the press release announcing Summit Packaging's expansion. With the support of Mayor Mason, the city created a new tax increment district to support this project. For those of you who are unfamiliar with Summit Packaging, the company produces valves and actuators for aerosol cans for companies such as SC Johnson, Rust-Oleum, and Procter & Gamble. This is a solid company in our community and one we are particularly proud to support. Renew Medical is a woman-owned business focusing on health and beauty. This company took advantage of our Zero RLF and the county's MGP program. A new company to Racine Patent Law Office purchased a building on Taylor Avenue to grow its practice using the Racine Development Group RLF, another one of our community loan programs. The last company I'll feature in Racine is Pawstar, a company we recruited in 2018. This company is growing and was provided a Zero RLF to buy equipment to help grow its customer base. The balance of companies utilize the Racine County Matching Grant Program for training and marketing expenses in the city of Racine. Altogether, Mayor Mason, you can be proud to say that 156 new jobs will be created by these companies, and they will invest $26 million in the city of Racine. Before I turn the mic back to Greg, one last great story to share. Her Valley had outgrown its location and needed a larger facility. Racine County's matching grant program funded some training for the owner, which will increase her client base. We are pleased to feature her in a press release, generate great social media, and recently celebrated with her at her grand opening. Okay, Greg, I'll hand the control back over to you to introduce our guest.
Thank you, Carolyn and Laura, for providing such a great summary report. I'm going to take a quick pause for a second here and see if Jeremy has any questions that anyone has in the chat function. So Jeremy, if you can give me a signal if we have any questions.
No questions at the moment, Greg.
Okay, thanks. Thanks, Jeremy. So at this point, I would like to introduce our speaker, Brian Andrew. As I mentioned before, Brian is the President and Chief Investment Officer of Johnson Wealth, and he is responsible for leading his investment team to build a global investment platform for institutional and individual investors. Brian joined Johnson Financial Group in 2015 with more than 26 years of asset management experience. With a Bachelor of Science in Business from the University of Minnesota and a certificate from Harvard CFA Asset Management Program, a CFA designation, Brian is certainly the perfect person to welcome today to help us make sense of our current economic environment. Brian has mentioned that he's happy to take questions at the end of his presentation. So jump into that chat function and Jeremy will keep us posted on any questions that we might have at the end. So welcome, Brian. We're so pleased that you're here today.
Okay, thank you, Greg, and thanks for the invitation. I appreciate the opportunity to share some insights regarding the economy and the markets, but I probably want to start by saying, after listening to those great reports, that what I want to try to do is put some of the noise that's going on from an economic and market perspective in some context, but also help people just recognize that this kind of volatility that we're experiencing is unusual because of the situation regarding the pandemic. And I'll talk about that as we go through this. But regardless of what's happening, businesses are able to grow and invest in themselves. And that's really what keeps things moving going forward. And we'll talk about that as we get into the presentation. So let me go ahead and get started here. I think, excuse me, if you look at the summary page, what I want to do is just sort of summarize what we're going to talk about over the next, 50 minutes or so, 45 minutes or so, and then we'll get into some of the specifics. So the first thing that I want to mention is that one of the reasons we're seeing what we're seeing from an economic perspective is because of the pandemic. And so obviously that's not something we experience on a regular basis. And so it has really disrupted both markets and the global economy, partly because many central banks and governments during the pandemic were trying to figure out how to stimulate economies, essentially fill the gap that was created from the government shutdowns that took place across the United States and really around the world. And so as a result, we saw unprecedented stimulus in the form of fiscal policies where the government was creating stimulus packages, in the form of even lower interest rates, and in the form of more liquidity into the global banking system. All of that is what we would refer to as a loosening of global fiscal and monetary policy. And now what we're seeing is the opposite of that. And a recognition on the part of the Federal Reserve that there was probably a little too much of that, likely because it was hard to predict the impact on the economy that the closures from the pandemic would have. And so as a result, tightening conditions, meaning higher interest rates and less government spending, tend to result in slower economic activity. And that's exactly what we're starting to see. In addition to that, lots and lots of conversation about inflation, whether it's food inflation or gas inflation or the cost of a used or new car. Everybody is seeing rising prices in a lot of different places. And a lot of that has to do with that stimulus. And what happened is as a result of the pandemic, closed essentially a lot of businesses, reduced consumer demand for some things and greatly increased it for others. And as a result, that increase in economic activity started to cause an increase in prices. And we've all heard about things related to supply chain issues as an example. Something as simple as, a business having a hard time coming up with plastic packaging or something of that nature, raises the price for things that are hard to come by. And so we've seen this price increase across the board, but we'll talk more specifically about how we think inflation is actually starting to peak finally and will improve. And then the other thing that I would mention is that the economy is slowing, but that's really not surprising because obviously we had tremendous growth when economies reopened in 2021 post the peak of the pandemic. And so that slowing gets us talking about a recession, and that's what we're starting to hear more and more about. And a recession just means an economy that's no longer growing, it's actually contracting. And so that's likely to happen, but not necessarily likely to be as deep as the last recession that we had in the mid 2000s. And I'll talk about that as well. So let me start here with just a conversation. And I should mention at the outset, I like to use a lot of charts to tell a story. Some people are visual. If you like looking at charts, I'll have plenty of them. But if you like listening to the story, I think you'll get there whether you are looking at the charts or not. So if you look at this chart here, those vertical gray bars represent recessions. And this is a period from 2008 to today. And if you look at the blue line, it recognizes economic growth. And you can see that big decline that we had back in January of 2020, where we had almost negative 10% growth, so a contraction of 10%. Then we had this big spike as things began to open up again. And not surprisingly, we're slowing down. And you can see headed back to kind of that long-term growth rate that we had near 2%. The problem is, though, if you look at the red line, you can see that's inflation. And during this entire period of time, inflation was pretty stable. And then all of a sudden, in January of 2021, we started to see an increase in inflation as a result of what I talked about in terms of supply chain issues, and really an increase in demand for both goods and services that led to rapid price increases as a result of capacity having been constrained during the pandemic. And I'll talk about that and give a couple of examples in a minute. So
hey,
if you
Brian,
look at,
this is
Jeremy.
Sure. This is Jeremy. I just wanted to give you a heads up that we had an issue sharing your screen, so I am sharing the slide on my end. So just give me a heads up when you'd like to advance the slide.
Okay, thanks, Jeremy. If you want to go to the next slide, then that would be great. Thank you.
Yep.
So if you look at this slide here, this is an interesting way of thinking about what's happening and this whole conversation about recession. So in blue, that represents the consensus or the way most economists think about where growth will be. And you can see this is in 2022, beginning in March of this year and through mid-June. And so consensus is that growth for the second quarter will be around 3%. The Atlanta Federal Reserve keeps its own statistics, and they create what they call a GDP Now forecast, which is more of a real-time way of looking at the economy, and that's in green. And the point here is that normally you see the green line in the blue line. Obviously, that's not the case. And as they're getting more and more information about the economy every day, they're saying that they're actually seeing things slow more quickly than the consensus. So that's important really for two reasons. One, it tells us that if we own a business or as individuals, we should prepare for a slower economy than the one we've been used to over the last year or so. It also suggests that there's a difference between the way market or investors are viewing the potential for growth and what the actual information is saying about the potential for growth. And that just means more volatility in the market. So if you go to the next page, I think what you can do is, one more time, thanks. And Jeremy, I should mention I have some animation in here, so I'll just try to help you with that as well. So if you look at this page here, this is the NFIB surveys small businesses. So if you think about small businesses, that's really where the bulk of employment is. And so the way that small businesses are feeling about the economy is really important. That black line represents firms' expectations of the economy improving. So obviously that line has gone through 0, which is in the middle of the page, and is now very negative. In fact, I drew this chart because it goes all the way back to 1986, and you can see that the small business sentiment for improving economic conditions has never been this low. And so we're at a point in time where we have to be a little careful about expectations becoming self-fulfilling, meaning that if businesses are very concerned about future economic growth, they may start to reduce activity, reduce hiring, and then that just exacerbates the potential for a recession. The other thing I wanted to point out though here is if you look at those little green bars and red bars, the green bars represent quarterly economic growth. So if it's green, that means the economy grew. And if it's red, it means the economy shrank. And so what's really important about that is that while we'll talk about a recession, and you'll certainly read a lot more about it, it is something that doesn't happen very often. It's certainly something to prepare for, but it isn't something to panic about. Recessions are a natural part of the way the economy grows, and you need periods of contraction. But point being here, from 1986 to 2022, you can see there are really only 4 of those periods, and they're relatively short-lived. So it's something that happens, but it's not something to concerned about as maybe sometimes the headlines would imply. So if you go to the next slide, I think what I want to do here is talk about a couple things. So we all know that inflation is high. And one of the reasons that the market has been so volatile this year is that we really started the year with people expecting those very high inflation numbers of 7-8% to come down substantially, really, and come down pretty quickly. And 2 things happened. One, the supply chain issues we had in terms of moving goods around the world persisted for much longer than people anticipated. And as a result, the lack of supply in certain industries has created higher prices for a longer period of time. Add to that the fact that as the economy started to grow post-pandemic, the demand for energy went up and went up faster than energy companies could return capacity. And then add to that the geopolitical concerns in Europe as a result of Russia invading Ukraine. And you have the situation we have today where inflation is much more persistent at a high level. So if you look at the blue line on this slide, what you'll see is inflation expectations for 2022. And you can see that today they're around 7%. If you just hit the advance button, Jeremy, what you'll see is the difference between 2022 and the orange line in 2023. Just there you go. And you can see that 2023 expectations are for a return to more normal levels of inflation, around 3%. So the question really becomes, and I think this is what we have to watch over the course of the next 6 months in particular, is whether or not inflation actually does start to improve as supply chains open up and energy costs improve. And we're starting to see that. If you go to the next page, I'll talk about commodity prices. And so when we think about commodities, we think about things like lumber, as you see here on this page, or think about precious metals like gold, or think about energy like natural gas and oil. And part of what happens when you get the kind of inflation we've had is commodity prices move up dramatically. And when you look at this page here, which is the spot price for lumber per 1,000 board feet, you can see the tremendous spike that we saw. So there's a red line there that shows that from a year ago, so this chart is from yesterday. So a year ago, or from a year ago, excuse me, lumber prices are actually down 6% from where they were a year ago. But for those of you that are in the construction business, you know that it's been difficult to predict where the cost of lumber is going to be. Part of that was a function of the fact that the lumber industry reduced capacity during the pandemic because they just didn't need to produce as much. Then with the reopening of economies, that capacity had to come online very quickly, and it took a while. And demand shot up as a result of the reopening and the housing boom. And so you got this squeeze, and as a result, this spike in prices. So imagine, if you're in the construction business, lumber went from just under $700 per 1,000 board feet to double that, over $1,400 per 1,000 board feet, and is essentially now back to about the same level that it was a year ago. But if you're in the business of acquiring lumber and using it to build things, that's a very challenging environment. And whether we talk about lumber or energy or precious metals or other commodities, agricultural commodities, you would see the same kind of thing. So going back to something that I said earlier, which is the idea that we think inflation is peaking, is a lot of commodities have seen this same pattern. So you can see here that lumber is off by almost 50%. If you look at the price of corn, it's down almost $2 a bushel. If you look at the price of oil, it's come down from over $130 to around $104. So we're starting to see, and if you just advance there, Jeremy, this downtrend that we're having in many, many commodities, which we think, since that leads prices, we think that rollover in commodity prices could potentially mean a faster deceleration of the level of inflation, which just means that the potential for much higher interest rates down the road could be lower as a result of that. So let me just follow up on the lumber conversation by talking about housing, something that obviously in the county is important and in the state and on a national basis. So if you go to the next slide, if you think about the housing market, it's a really important driver of the economy. If you take just housing and the money that's spent to build homes and just build homes, the input into the economy is about 4 or 5%. If you add all of the things that drive the economy and drive growth that have to do with housing, which includes improvements, landscaping, furnishing a house, etc., all of that means that housing actually is near 20% of the US economy in terms of economic activity and spending. So paying attention to housing, I think, is really important. And so if you look at this slide here, there are two things going on the slide. And this goes back to 2016. Remember that gray vertical bar there just represents a recession. So in blue, that's the number of permits in places where they issue permits that are given on an annual basis or annualized basis. And in red, that's the number of homes started. And so it's important to think about the fact that obviously in most places you have to get a permit before you start building. But in that intervening time, if things change in terms of the sentiment of a new homeowner or a builder, you may see starts move lower faster than you see permits. And so sometimes it can be a little bit of a leading indicator in terms of activity. So if you look at where we are now, as an example, if you just advance there, Jeremy, you can see this big decline in starts. And so that's just and it's a big number. We were at 1.8 million units on an annualized basis in the United States. We've come down to about 1.55 million. So we're 250,000 homes fewer started now on an annualized basis than where we were just a couple of months ago. So it's something to keep an eye on, but here's something I want to just remind people about. I know there's a lot of concern that the housing market looks like the housing market we had in 2006 and 7, which means we could have another 2008-9 financial crisis. And there are certainly parts of the market where home prices, and I'll show you that in a second, have really grown tremendously. I think the important difference between today and that time back then is demand. So one of the things we've talked a lot about for almost the last decade now is the idea that younger millennials and older Gen Zers, so think people between the ages of 25 and 35, are entering the housing market as they begin to have families and are interested in leaving either a condo or an apartment. They're looking to housing, more permanent housing, as a way to move their families. And so the demand is much more significant today than it was then because of the size of that group. So we talk often about the fact that that's a group of people, around 70 to 75 million people, half of which are in that sort of age range that I talked about. And so there's a lot more demand for housing today than there was in 2008-9 as a result. And you see that a little bit if you go to the next slide. You can see what's happened to home prices, excuse me, as I've talked about. And I think also the other thing that we've seen is interest rates. So if you just advance there, Jeremy, that blue line and that arrow that he just drew represents how much interest rates have gone up for a 30-year mortgage. Interest rates are on the left-hand side of the slide. And so a mortgage that was 3% less than a year ago, today is almost 5.5%. So we've seen a huge increase in interest rates. But for those of you that recall buying a home 30 or 40 years ago or 20 years ago, this is really still a relatively low rate. Higher interest rates make homes a little bit less affordable, but on average, a 5.5% mortgage is relatively low if you look at the last 40 years or so as an example. So it will have an impact on demand as people have to adjust to higher interest rates, but we don't think as significant. The other thing, if you just advance one more time there, Jeremy, the thing that you'll notice is that we have seen a major spike in home prices. And this red line represents the average sale price of a house. And you can see it's gone from around $375,000 back in the beginning of 2020 to almost $500,000 now. So there's been a tremendous increase, but the reason for that is similar to why we're seeing post-pandemic inflation. Think about the financial crisis of 08, 09, and what happened to real estate developers, what happened to the acquisition of land for development, what happened to the cost of construction and the labor market. It really went through a very, very difficult period. And so our ability to build new homes contracted significantly at the same time that we started to see this younger age group enter the housing market. So not surprisingly, you started to see an increase in prices because demand was growing. It will take some time to find a new balance point, but I think that will happen. And you'll likely see that home price come back down again. And certainly lumber cost is an example of why that number's up so much. Remember, I said we went from $700 to $1,400 per 1,000 board feet of lumber, and now we're back to under 700. So there's a lot going on there, but I think that the important thing is that demand will continue because we have a different demographic today than we had over 10 years ago. And you'll likely see a moderation in prices as well as a stabilization of mortgage rates. So if you go to the next slide, I think one of the things I want to shift gears a little bit and talk about demand and talk about some of the things in the economy that can improve and keep the recession, if we have one, from being relatively modest. And so the first thing that I would do is take a look at the vehicle market. So the auto industry, as most of you know, is a huge contributor to the economy for lots and lots of different reasons. But one of the things that we've seen, obviously you can see this because of the pandemic, is that the production of autos declined from over 17 million units a year to just over 8, which is just dramatic when you think about that happening inside of a period of several months, and that's annualized units. So we were selling about 17 million cars and trucks a year before the pandemic. And then you can see post-pandemic, we got back to sort of that same level of 17 plus million, maybe a little bit higher because of the demand loss during the pandemic. And then supply chain issues started to creep in. And a lot of the auto companies have talked about the fact that they literally have hundreds of thousands of cars that they can't get the right chip for to produce the right kind of things that people want. So heated seats and a heated mirror, you need a microchip to make those work. You can't sell a car in Wisconsin without those, or at least it's more difficult. And so without those chips, they have a hard time moving those cars. And so you see this decline in production. And now we're at kind of a 13.5 million unit a year rate. However, as those supply chains start to open up, I think you'll start to see auto sales recover where they were pre-pandemic because the demand is there. The idea that many more of those cars will be electric, I know a lot of people still think that's not a thing, but it is. And one of the reasons that you're seeing this slowdown is that car manufacturers are trying to figure out how to transition from combustion engines to electric. And as a result, it's a huge change in capacity, hundreds of billions of dollars of investment, but it is taking place and it will continue to take place as we move forward. So let's just talk about energy prices for a second. And if you go to the next slide, I want to talk about this in a way that's similar to housing. So if you think about the production of oil as an example, or natural gas, and think about the pandemic, basically people stopped moving around, people stopped driving, people stopped flying to a large extent. And so, we had a decline in economic activity, manufacturing slowed down, so the need for energy was reduced. And so not surprisingly, companies that are in the business of getting oil and gas out of the ground and refining it really slowed down that activity in a very substantial way. So if you look at this chart here, this just looks at the number of oil rigs in shale producing areas to make this point. So if you look at, take the peak on the right-hand side, go back to really the beginning of 2020, and you see that cliff where we went from over 500 rigs operating down to just 100. So the amount of oil that was being pulled out of the ground dropped dramatically. And you can see relative to the peak back in 2015, which was over 700, that we had a substantial change here. So the point of that is to say that energy is not much different than lumber, which is because of the pandemic, demand declined, capacity was reduced, so people stopped producing as much. Then post-pandemic, demand accelerated much faster than capacity could be turned back on. And as a result of that, the demand causes prices to go up. And the more demand you get in the face of limited capacity, the faster prices go up. And so that's what we've been experiencing. Add to that, of course, Russia's invasion of Ukraine and the cause of major energy disruption in Europe, because Europe depends on Russian oil and gas. You have a major problem for the oil industry, and that's why we saw oil prices on a per barrel basis go up to $130 a barrel. The US actually is exporting more oil today than it has for the last 10 or 15 years. So we're still in a situation where total oil production in the United States should be around 14 million barrels a day. And we're at around 12. So when you have less production than you have demand, you end up with higher prices. And on the next page, you can see that that shows up at the pump. And so there's a few things going on in this slide. In blue, that's the cost of a barrel of oil. And you can see that in blue. In green, or gold, I guess that is, that's the price of gas. And then in orange is the price of diesel. And if you had just advanced the slide a little bit there, what you'll see is that the price of oil, where that arrow is, has rolled over. And we've started to see a decline because production continues to go up. And that's one of the things about oil, is the higher prices get, the more producers want to produce because they benefit from those higher prices. And eventually you see some stabilization in the market. If you advance one more time, though, what's interesting, and you see what's happened, is that orange line and that arrow that was just drawn there, that's the price of diesel. And diesel has not rolled over as substantially as gas or oil. And that goes back to what I said about the fact that it's more difficult to get that refining capacity online. And obviously demand for trucking in particular, as it accelerates or goes up when the economy expands, that creates a problem, and ultimately higher prices. So I think longer term, we'll see some stabilization in the price of oil. We'll see some stabilization in the price of gas. We've already seen gas come off its peak at the pump, but that's not to say that we won't continue to see it higher. But going back to what I said before about inflation peaking, this is evidence that we've seen sort of the peak level of inflation, and we should continue to see some improvement in prices as we go forward. So if you go to the next page, I want to just call out an important point because it's very different from what's happening in the United States and Europe, and really a large part of the rest of the world, and that's China. So remember, China is the second largest economy in the world. And as a result, when China is not doing well, a very large part of Asia and other parts of the world are not doing well, and vice versa. So I talked about the fact that we're worried about a recession, but the possibility of that recession is really that it may be milder than what people are used to thinking about. If, as an example, you think about 08, 09. And this is one of the reasons for that. If you look at this chart here, and if you just advance one, what you're seeing, this is just manufacturing, purchasing managers index for manufacturing in China. And what you're seeing is a huge rebound in the level of purchasing manager activity. And we measure that because it's a way of thinking about what might happen in the future. And so that rebound is suggesting growth. I should have drawn it there. You can see there's the number 50. Above 50 is expansion, below is contraction, and that number is now back above 50. So China is unusual with respect to COVID because it has a zero COVID policy. And so this year, as they started to see an increase in infections, they were actually shutting down again in major cities. If you think about Shanghai as an example, Shanghai is almost 6% of China's economy, and it was closed for almost 2.5 months. So as we start to see reopening and more economic activity, consumer activity, we're starting to see an improvement. Point being there that because of the size of China's economy, that will likely be good for the rest of East Asia and probably the global economy. And that's one of the reasons the recession may be milder. So if you just advance again there, you can see that increase or that rebound I was talking about in manufacturing activity. And that's a reason to think that if we have a recession, it may be a bit milder because of the fact that China's doing the opposite of what everybody else is doing. They're lowering interest rates. they're deregulating. They're trying to make it easier to do business because they're trying to get over the economic contraction that they've been facing. Okay, so let's switch gears and just talk about where we are from an interest rate perspective. I know lots of you, whether you're a business that borrows money or an individual that buys CDs and earns interest or pays interest on a mortgage, we're all interested in what's happened with interest rates, and it affects our businesses and us as individuals in lots of different ways. So one of the ways that I like to look at interest rates that I think is the easiest thing for people to keep track of is to pay attention to the interest rate on a 2-year treasury. So 2-year treasury bond is issued by the federal government. It's their way of borrowing money from investors for a period of 2 years. And the yield on that is the interest that they pay that investor for having borrowed the money. And so when you look at this chart, it's tremendous to think about the fact that just over a year ago, a 2-year treasury had an interest rate of almost 0.5%. And today, as you can see on the right-hand side, that yield is, or interest rate is 3.07%. So we've had a tremendous increase in the level of 2-year treasury yields. And that's a result of two things. One, I said earlier that the Federal Reserve lowered interest rates to try to keep the economy propped up during the pandemic, and maybe kept them too low for too long. And now with the economy having heated up, last year we saw growth over 10%. They're raising rates to try to slow down economic activity because higher interest rates make it a little tougher to borrow, make it a little tougher to buy a house, et cetera. And so we've seen this increase in interest rates, and this isn't unusual. It's a normal cycle event. What's different is the fact that rates were so low, near zero, and now inflation is very high. So that's a simple way of saying that the Fed is behind the 8 ball, so to speak, in terms of needing to move rates up to stave off inflation. The other reason I like the 2 years is all of us can look in the paper or Google it online and say, you know, what is the yield on a 2-year treasury? And it's a way of telling you what the market thinks the Fed funds rate or the overnight rate will be out 2 years. And so today, if you think about it, the Fed funds rate is around 1 3/4. That's the rate that the government controls or the Federal Reserve controls. And so the market is saying we think it's going to get to 3%. Not stay at 1 3/4. So for most of us, that means higher short-term interest rates. That means over time, higher interest rates on money market funds and CDs and short-term bonds. So for investors, that's a good thing. For borrowers, it means that, you know, if you're borrowing money, you can expect to see the cost of that money go up as we move through 2022 and into 2023. But there's some good news here, and that's if you look at this next page, I think I'm going to just have you focus on, if you just advance the slide and just hit advance one more time. If you look at that table that's on the right-hand side here, I just want to point this out because this has been a really tough year for investors. Stock returns are negative and bond returns are very negative. What the point of this slide is, and this is really a long-term chart, goes all the way back to 1927. And what it says is that it's not very often that the bond market has a negative return 2 years in a row. And when it does, it has historically always been good news for the next 2 years because the next 2 years are positive. And so if you look at that table on the right, that far right, I just highlighted the March 2022 period there. We've had a 2-year negative return for bonds, but it probably means now that rates are higher, that the next 2 years will be positive. So I know a lot of people are bond investors and they're not used to seeing negative returns in bond portfolios. And that's tough in the current environment, but it's probably good news in terms of where we're headed. And for people who are saving money, savers in particular, it's been a tough go with interest rates near zero. And so savers will get a break finally, and we'll start to see savers earning money on that savings, whether it's in money market funds or CDs or bond funds and so on. So we should see better news for bond investors going forward. So let me just shift gears and talk about the stock market, and then we'll wrap up for questions. So just real quick, I know it's been a really, so if you advance the slide, it's been a really, really tough go for stock investors this year. One of the reasons for that, though, is that prices got way ahead of themselves in stocks. And what I mean by that is that there was sort of nowhere else to go with money when interest rates are at zero, as they have been for some time because of the pandemic. What happens is people with money seek out investments that they think will earn a better return. And not surprisingly, they found the stock market. And oftentimes what happens is stock prices get pushed up to levels that really don't make sense based on the earnings of companies. And we saw that happen. So another way to think about that is while the market is down, you can see here in blue, that's the S&P 500 index of 500 stocks in the United States. It's down over 20% for this first 6 months of the year. The technology heavy NASDAQ index is down almost 30%. And there are individual companies that are down 50 to 70%. So a lot of the sort of heady days that we had post-pandemic, we've seen prices come back. They're still, though, higher than they were if you go all the way back to 2019. So it has been a volatile time for stocks as people have to recalibrate their earnings expectations based on slower economic growth, but not really that unusual given how much performance we saw from the stock market in late 2020, second half of 2020 and 2021. So I think for investors who have money to put to work, obviously with stocks being 20 to 50% cheaper, depending on where you're looking, that's not a bad place to be as an investor with new money. So if you just go to the next slide, I wanted to put those two things together. So I talked about the fact that interest rates will likely be moving higher, and the fact that the stock market has done really poorly. So what happens to the stock market when interest rates rise over time? Well, most people assume that stock returns are bad. And the fact is that isn't true. And if you look at the slide here, this just breaks the stock market down by industry. So energy is on the far left as an example. Utilities is second in from the right. And what you'll notice is that all of those numbers are positive. So historically, when interest rates rise, stocks are positive over that whole period of time that rates are going up. And I would note in particular, if you look at the first two bars on the left, that energy stocks do really, really well, and financial stocks do really, really well. We'll start to hear more about this as we get earnings reports later this week. JP Morgan, as an example, reports earnings later this week. And what happens to banks is they're able to earn more between the deposits they take in and the loans they make when rates are higher. And so earnings get better. And as a result, stock prices generally move up, not down. So point being that I think there's an opportunity here with stocks at a much lower level to see positive returns from stocks going forward. And then one last thing, if you go to the next slide, I want to just mention for the group, is if you look at where we are, this is the midterm election year. And I'm sure most of you have been seeing election advertising already. But as an investor, I think about what happens during elections and what happens to markets, I should say, during elections. And the reality is that markets are pretty volatile in election years. And this chart is just a picture of volatility. And you over the 4-year election cycle, going back to 1950, and you can see that there's a peak in the third quarter of the second year of the election cycle. Well, that's this year. So the third quarter of this year, we would expect to see more volatility. And that's just because stock investors are trying to figure out what happens to policy making as a result of the midterm elections. And you can see the same thing when you look out in year 4 of this cycle, you get the same kind of peak in volatility. So we've already seen a lot of volatility this year. I guess this is a way of me saying maybe expect to see a little bit more as we go through the year, because I think that's generally the case. And in particular, when you see the potential for change in control of Congress, which seems to be a potential issue this year. So something to keep an eye on, not necessarily something to worry about. I think the other thing I would note is, going back to what I just said, is that the market seems to be priced for Republicans taking over Congress. If that turned out not to be the case, or turned out not to be as significant as today's expectations, then that would suggest the market's mispriced, and you'd likely see some volatility around that as a result. Okay, so let's just go to the last slide and I'll just wrap up, and then I'm happy to take questions, as Greg mentioned. So we're going to continue to see this tug of war between inflation and growth. And inflation, I think, will continue to moderate, but so will growth. And the question is, which one moderates faster? Meaning, how much faster does the Fed have to hike interest rates? The more growth slows, the less they have to worry about it if they get inflation under control. And we've seen commodity prices, as I mentioned, lumber and agricultural commodities and energy prices start to roll over. So we will likely see in the future consumer prices start to roll over. However, the Fed is behind, and so we'll continue to see rates rise. The pace at which inflation comes down will dictate just how high they go. And then in thinking about a recession, I think a recession is likely. We shouldn't be so concerned about it. We should plan for it. If I'm a business, I have to plan for that slowdown. If I'm an individual, I have to save more and plan for that slowdown. But recognize that there are some pockets of growth. I mentioned this younger generation of housing buyers because that's growth in the economy. I mentioned China because China's actually doing the things they need to do to strengthen their economy, and that results in more global growth. And then most importantly, unemployment is at 3.6%. So the labor market is very strong. There are 11 million open jobs and only about 6 million people to fill them. So that's a pretty big cushion on unemployment, even if the economy slowed a bit. And so that may be the case as we move forward. So again, I want to thank the group very much for having me today. I appreciate everybody's time. And as Greg said, I'm happy to take questions. I'm not, I don't see the chat. So Jeremy, I don't know if you're going to read those off or Greg's going to read them off, but I'm certainly happy to take questions if they come in.
Hey, Brian, first let's wrap it up with a couple of questions. So I'm going to go into the chat and I have 2 questions I'm going to read to you, 2 great questions, both from Tony. So the first one, Brian, isn't the price of oil and gas going to remain high given if the European markets are starved of supply and the US producers will just shut there? Why sell in the US market at cheap prices when you can get a premium in Europe? So that's the first question.
Yeah, that's a great question. And so when we talk about remaining high, it's kind of a relative thing, right? So do I expect oil prices to go back to $25 a barrel like we had in 2015? No. Do I expect them to move from $130 or $40 a barrel back to 70 to 80? Yes. So I think that means that not only will oil prices remain higher than they've been historically last 5-6 years, but they will certainly not remain as high as they were, because what will happen is production will continue to increase.
Hey, another great question from Tony. So Brian, how much of the technology stock decline is due to the crypto crash versus the core technology stocks like Microsoft, Apple, et cetera?
Yeah, I think one of the things that's happened in technology stocks, like those you just mentioned, Microsoft and Apple, and Amazon would be another good example, is at the beginning of the pandemic, people weren't sure where to go with money in the stock market. And so they chose those stocks because they're great growers, and actually in many cases were benefiting from pandemic related investment. But they were bid up well beyond where they should have been. And so we've seen that, correction take place. But they're still great companies. They're just great companies that aren't as expensive as they were 18 months ago. And so probably an opportunity.
Well, it's great to end on two fantastic questions. And yeah. Brian, I could listen to you all day long. I just want to thank you on behalf of RCEDC for joining us this morning. I thought your presentation was excellent and insightful. Your slides were terrific, and we really appreciate your very thoughtful commentary. So thank you so much for joining us.
Thank you for having me.
For those of you who are in the gallery still, this event has been recorded and will be delivered to everyone who registered for today's event. So some of you had put comments in the chat that you'd love to have another look at Brian's slides. The recording will enable you to do that. So get your calendars out and mark our next Leadership Council meeting is October 11th. So make sure you've got that on the calendar. And we're going to focus our attention on real estate development at our October meeting. Of course, more information on that meeting will be made available to you in the coming months. I want to thank everyone for joining us today and have a great day, the rest of your day. And we are adjourned, and we'll see everybody next time. So bye for now.